What are shares? What is the share market and how can we begin to start trading in shares? In order to start and grow any kind of business, you need a lot of capital, that is, a lot of money. To acquire this amount of capital, a company must be divided into small parts. This means that the ownership of the company is divided into parts and these are distributed to the public in the form of shares. The public who buys these shares and have possession of the shares are called shareholders. In some companies, shares exist as a financial asset and provides equal distribution of any residual profits, if any declared, in the form of dividends. Shareholders of a stock that pays no dividends do not participate in distribution of profits. Instead, they anticipate participating in the growth of the stock price as company profits increase. Most companies have shares, but only the shares of publicly traded companies are found on stock exchanges. This is the basic explanation of what shares are. Now that you know what are shares, we'll take a look at what is the share market. If you want to purchase something, where do you go? You go to the market. Similarly, if you want to buy shares, you go to the share market. The share market is a broad term which refers to all the companies which list their shares for the public to buy. In earlier times, before the boom of the Internet, the buying and selling of shares used to take place physically. But today, in the Internet era, these shares can be traded online. The companies list their shares on a formal organization, which are the stock exchanges. There are many stock exchanges in the world which conduct trading of shares. For example, in India, the two most popular stock exchanges are the National Stock Exchange or the NSE and the Bombay Stock Exchange or the BSE. All companies which issue their shares need to be registered in these stock exchanges. A company decides to go public when it earns profits and public demand for the company's share increases. This process is known as initial public offering or IPO. This launches the company in the official public market, where any company or individual who believes the business could be profitable might buy a share. The investors who buy these stocks become partial owners in the business. Their investment helps the company to grow, and as it becomes more profitable, more buyers may see potential and start buying stocks. As demand for those stocks increase, so does their price. This raises the value of the company's stocks that people already own and also increases the price for prospective buyers. This increases the company's overall market value. However, if for any reason, the company starts to seem less profitable to the investors and they think their stock value is going to decline, they'll sell their stocks with the hope of making a profit before the company loses more value. And as the demand for stocks goes down and stocks are sold, the stock price falls, with the company's market value. This can leave investors with huge losses, unless the company starts to seem profitable again. Companies are under the influence of market forces. These changes in demand and supply are influenced by many factors, like changes in production technology, fluctuating prices of materials and costs of labor, or even larger factors like new laws and policies. Due to these many variables, the stock market is a highly unpredictable system. In this modern Internet era, everyday investors can buy stocks, and as people educate themselves about this complex market, they too can trade stocks, support businesses to grow and earn some profit themselves. Thanks for watching. If you want to see more informational videos, subscribe to this channel and press the bell icon to get notified. Stay tuned for more.